Hi, welcome to the Adhesion Manager Spotlight. For today is August 22nd, 2019. Today we'll be highlighting Anchor Capital. And on the phone we have President Eric Lake, who will be guiding us through some of the Anchor Capital strategies. So Eric, please take it away. Thanks for being here.
Thank you, Patrick, and thank you everyone for joining us. We're excited to be a part of the Adhesion platform. It's a real privilege to be able to offer our risk mitigation and tactical strategies to advisors. We've been excited about this call for a while. For those that don't know, Anchor Capital, we've been around, 25 years. We offer a variety of strategies that are designed to mitigate risk, manage opportunity, and smooth volatility for portfolios. We started off as a separate account manager in 1996. Our whole focus of our firm for 2 decades has been really managing the risk, the macro market risk outside of single portfolio position risk for advisors, for institutions, for funds, and we bring more than 40 years experience between my partner and myself. So it's pretty exciting. This environment that we're in right now really lends itself to volatility management. We offer anchor-specific mutual funds. They're risk managed long, short, and we'll get into that. Turnkey model portfolios, where we combine our risk management with passive asset allocation. And then we also do custom institutional SMAs for large institutions, $50 to $100 million and up, where we customize things specifically for an institutional mandate. What separates Anchor Capital from other firms? There's a lot of tactical managers out there. For decades, there's been folks that will apply some sort of a model or a signal or a trend following strategy to capture market trends on the upside and avoid, down markets. Those have been good strategies, they've worked, but we think that it takes more than just a single time frame or a single factor to really exploit and take advantage and actually protect clients, because risk exists in more than one time frame. So we apply something we call multi-factor and multi-duration. And it's a big separator between us and other tactical managers. It's very straightforward. Our process starts by looking at the macro long-term trend. Where are we at in the business cycle, right? We want to participate in multi-year economic expansions. We want to be fully invested as much as we can and generally ignore short-term volatility. These types of strategies, though, they typically lag the top and bottom. So, the market bottom in 2009, for example, these types of strategies will wait to make sure that's a confirmed bottom before they get exposure again. And typically markets have to turn down 10, 12, 15% before these types of strategies move into protection. That's why the standalone, that can be disappointing when you have these sort of whipsaws in short-term corrections, because the corrections already happened and your strategy didn't protect you. That's why we marry the long-term trend with our second step, looking at the intermediate-term trend. Intermediate-term trends are 3 to 6 month momentum. It's more opportunistic, and it serves to offset the lag that can happen from the long-term trend. And if you think about the types of events that happen in a 3 to 6 month period, that's 2 quarters, right? Maybe even 3 quarters. On a 9-month trend, you've got multiple earnings reports, you've got news events. The intermediate term trend can be a leading indicator into what's happening on the long term. So when you put those two together, you have a much more broad view of risk or opportunity in long and intermediate term trends. But that also is not enough. Once we address risk on the macro and we address risk on the intermediate term, we also have to address risk and opportunity in short-term volatility. Short-term volatility is the counter opposite of trend following. Short-term volatility really exploits the inefficiencies of investor behavior. It exploits the inefficiencies of extreme market sentiment, and it serves to smooth the sharp corners of just trend following. We explain it like this. There's the efficient market hypothesis, right? This idea and this concept that came out in the 60s that said that markets are very efficient, all prices are known by all market participants, and investors always act rationally. Well, we know that, 40, 50 years later, we know that that's not true. We know that investors can be highly emotional and overreact. So on a long-term basis, markets are fairly efficient at pricing economic data. But on a short-term basis, the more short-term you move from market efficiency to investor fear and panic and overreaction. The last couple of weeks are a great example. July 31st or end of July, we're at a new all-time high in the S&P. Over the last 3 weeks, we've seen the S&P correct as much as 4.5% and have volatile trading. What has the last 3 weeks told us about the U.S. economy? Absolutely nothing. We can't glean anything about the economy from the trading of the last 3 weeks. We can gauge investor sentiment. On a long-term basis, the macro uptrends are still in place. So what does it look like to put all these together? This is our process. This is our multi-factor, multi-duration process. Address risk and opportunity in long-term, intermediate, and short-term volatility. We apply that to the 4 core asset classes that advisors have in their portfolios: domestic equity, international global equity, taxable fixed income, and tax-free. Those models address the long-term, intermediate-term, and short-term volatility of each of those asset classes. And when you put them together, our offering is very simple. On the Adhesion platform, we have 2 offerings. One, our risk managed sleeves, where we combine our risk mitigation mutual funds together in a total solution of a risk managed sleeve, where advisors can use that to sleeve into their equity, sleeve into their international, their fixed income, manage risk, and manage opportunity. And then for advisors who say, well, how much should I have? I'm not sure how much equity I should have. How much fixed income should I have? We have turnkey total solution portfolios where we combine efficient asset allocation, passive indexing with our risk mitigation sleeves. So let's take a look at what that looks like. Our risk managed sleeves are basically where we have simplified the approach to adding risk management to your portfolio. A lot of advisors over the years we've worked with have asked for a simplified approach. So it used to be that you used to have to come to our SMAs. We used to have to jump through a lot of hoops. We've made all of our SMAs now available as mutual funds. Turnkey funds, super simple. If you want to add a long-short strategy to your equity sleeve in your portfolio, our tactical equity fund is available. But it's a simplified approach to add that protection, add that volatility management. We can get into tickers and things in another call, but this is just a very simple approach to show you not only do these funds and these strategies have low correlation to their benchmarks, they have low correlations to each other. And if you look at our 10-year model history, the correlation is very, very low. That's why they work so well together in a managed portfolio. Simple example, right? We live in kind of a 60-40 world. Typical portfolio, moderate portfolio, on average, 60% equity, 40% bonds. We call this our alternative 60-40, right? So if we take a completely simple, we are really oversimplifying here, 25% even allocation to each of our tactical risk managed strategies, what does that look like compared to a non-managed, just index 60-40? Here's the results. January 2007 through July 31st, 2019, annualized return in the black for a traditional 60-40, obviously no fees included, compounded return at almost 7% a year, not bad, and a drawdown of 32% versus just an S&P drawdown, which was 50%. So by balancing between stocks and bonds, you have a better return than just being in all equities. However, the Anchor risk managed sleeve, 13%, a little more than double, with a 4% peak to valley drawdown. And these are all based off of audited model numbers, and all of our returns are all certified, and you can contact us for those individual numbers. This is a simple example of how adding risk mitigation, Anchor tactical risk managed strategies into a portfolio can smooth returns and harvest opportunity. The other solution we have, if you don't want to build your own portfolios on the Adhesion platform, is our turnkey portfolios that we call total solution portfolios. We have a really cool white paper coming out where we talk about modern portfolio theory. We talk about where it came from, the history. We talk about some of the challenges, and really what the paper illustrates is what we call the correlation conundrum. The challenge investors have when modern portfolio theory is their only risk management approach. They just diversify across non-correlating assets. There's academic research after research after research that show, and our own work has shown, when markets undergo stress, when markets have volatile periods, correlations rise. So the only time you actually need your portfolio diversification to work, it fails. So Anchor's approach is we combine the benefits of passive investing and asset allocation with our risk managed sleeves, because our sleeves are designed to reduce correlation in volatile markets and actually get inversely correlated in full bear markets, because our funds can go from full long to full short. Now, we use that three-factor approach to get there, but when you combine passive with Anchor's tactical, you get a much smoother return. And clients also have a portion of their portfolio that remains invested all the time. So you kind of have the best of both worlds. What does that look like? It looks like this. This little graphic is our approach at trying to illustrate how the total solution portfolios, the core holdings remain fully invested all the time. And our tactical risk managed funds are either adding to the exposure by being fully long and looking like the rest of the market when there's low volatility. But when the volatility starts to pick up, when trends start to roll over, our funds will become defensive, and then we'll actually, if we go into a bear market, they get short. And that's what you want from your diversifiers, right? If you're going to stay fully long ETFs from your favorite family, you need to have something in the portfolio that's going to offset that, and that's what the Anchor tactical strategies do. Just running through quickly, because I know this is a brief call. Here's a look at what that looks like. We have a growth, we have a moderate, we have a conservative. Over the last 10 years, January 2007 through last month, you have almost 11% annualized versus a 9% peak to valley drawdown. But you can see the significant outperformance, and it's really about volatility management. When we can deliver to clients a consistent return stream that doesn't have these sharp edges, that doesn't participate on the downside, advisors are able to build a stronger business, keep clients, have a much more higher value practice than having to constantly recruit clients after you suffer through periods of volatility. Here's our moderate portfolio. Again, you can see the results, and then also our conservative portfolio. There's really two ways to work with Anchor. We have our individual strategies and our risk managed sleeves, and we also have our turnkey total solution portfolios. They're all available at Adhesion. A little free gift we'll throw out today. A lot of questions we get around here are, hey, Eric and Garrett, we know how to make money in a bull market. How do you guys make money in a bear market? Well, the first thing you have to know about making money in a bear market is understanding how they function. So we have this fun little piece that's like 3-page, 4-page piece where we talk about the differences between bull and bear markets. And it might be interesting to know that they're not opposite. Bull markets are not opposite from bear markets. They're completely different. How they act, what they look like, what they feel like, what the price movement is, they are radically different. And so how you generate returns and protect capital in volatile markets is a very different approach than what you do in a bull market. So we put together this little piece called the Bear Market Roadmap. Contact us on our website, and happy to give you a free copy. We also have tons of research and insights on our site where we share views and exposures and kind of what our take is on the market. Other than that, we will open it up to questions.
Awesome. Thanks so much, Eric. That was great. I really appreciate it. So just kind of wanted to recap on my end. So looking at 3 distinct factors for Anchor, which is long-term price trends, intermediate-term price trends, and short-term volatility that you guys really apply as a decision framework. Is that accurate?
You've nailed it.
Awesome. Okay, so with that in mind, this was just to kind of give you guys a sense, this is a total portfolio solution like that we have in the Adhesion platform that combines that tactical risk management with core asset classes. And so this is, if you guys are looking, if any advisors listening are looking for something that can really kind of do the whole thing, this is a really, really strong way to approach it. That kind of differentiates itself from having to build up from typically the core to the satellite. And doing it yourself. So I wanted to kind of point that out there. And we did have a question come in. So given the relatively the pretty recent pullback in the markets, how did your managed risk sleeve really respond to, I guess, the recent market volatility?
We've been really happy and proud of our performance. You've had basically 4 rounds of volatility in the past 2 years. In May, you had a pretty good sell-off. Our tactical strategies performed beautifully, basically flat through that period. In this month, I mean, the month's not over. I think our equity strategy is still positive, 60 or 70 basis points on the month. S&P is still negative, I think 1.5 or almost 2%. The biggest rounds of volatility that we've had over the past 2 years, if you recall, back in January of 2018, we had the end of January, beginning of February, you had the VIX blow up. S&P has a 10% correction. That's a great illustration of our risk management. So you have 17, our equity strategy participated on the upside. I think we're up 17%. S&P is up 21 or 22. Great year. That's an example where low volatility, we're fully invested. And that's the power of our multi-factor, multi-duration approach is we're not a dedicated long short where we always have a book of shorts and a book of longs. We will tactically manage those exposures. So when there's no volatility and the trends are up, we want to look like the market. In these strategies, we're not taking any single name risk. We're not using leverage. We're not using options or derivatives. Our funds invest purely in ETFs. So they're broad, highly liquid, index-based ETFs, and then we're going long and short and managing the exposures there. But in 2017, you have this great bull market. The first 3 weeks of 2018, that's carrying through, and the S&P's up 7.5 or 8% in the first 3 weeks. It was a straight up run. So let's take a look at what our models were saying at that time. Macro long term, fully invested, right? Intermediate term, fully invested. But on a short-term basis, our volatility measures, one by one, began to flash red. They began to say, we are at an extreme here. We are overbought. Volume is drying up. All the things that we look at. Right around the end of January, we began to hedge and put short positions against our longs. And just within about 2 days, you had that correction in the S&P, and we sailed right through it. I think we were down 1% while the S&P was down nearly 10. Same thing happened again in the fourth quarter. In 2018, I think we're one of the only long-short managers in the country in the entire Morningstar database that was positive in 2018. S&P was down, 4% in 18? I think we're up almost 3.5. So I'm just giving you data points to answer that question, how we've been doing the volatility. Every time we've had a round of volatility in the past 2 years with these funds, the exposure management have worked very well, and they continue to work.
Awesome. Appreciate that. Cool. And we did have another question here. So within that same, I guess, would you guys consider the Fed and sort of their recent actions to be more of like a short-term volatility thing that you guys monitor, or is that more of like an intermediate term type thing?
So we would have a lot to say about that. The Fed is really driving. The Fed and global banks in general are the theme. I mean, we just did a webcast a week ago talking about currency wars. We've been out with pieces about currency war and federal bank intervention for a couple of years. So the short answer is yes. Yes, the Fed's movements are a key driver to short-term volatility. They have been for 10 years. They have been since the credit crisis, and they will continue to be. What the Fed has done in their pivot, I mean, right now, we're the #1 municipal bond manager in the Morningstar database for our tactical municipal bond fund. And part of the reason is part of our multi-factor approach to our tactical municipal bond strategy is when to pivot on rate changes. And you had the Fed for 2 years, 2.5 years on a tightening cycle. And then finally in November, they pivoted and said, we're going to take a dovish stance. That is where our tactical model moves from a hedging position to a net long position. And we typically use closed-end funds for that. So the Fed has given the anchor strategies a number of opportunities to exploit that. But it's not based on a fundamental view. It's based on our quantitative measures of long-term macro, intermediate term, and short-term volatility in each of the asset classes separately that we manage.
Awesome. Perfect. I didn't see more questions on our end. But that was super helpful, and this is a great way to kind of get to know you guys a little bit more and how you guys do what you do. So I really appreciate you taking the time today, Eric.
Yeah, thanks for, if anybody's still listening and hasn't stopped watching this thing, but I wouldn't put you to sleep, reach out to us. We love to share ideas and talk markets, and love to work with advisors on how our strategies can help their practice.
That's great. Yep. And if any advisors are listening, please feel free to reach out to your account manager directly. I'm happy to help out and get you in touch with Eric and the gang over there. So again, thanks very much for your time today, everyone, and hope you have a great day.